And we are back. This is chapter 8 of Liberate Investing. This is the fourth video in this chapter, and we're going to be talking about returns and volatility in this video. So we have already discussed the power of compound interest, but it really matters in the accumulation phase of your FI. The higher your annual compound interest, the faster your wealth will accumulate. However, you must consider the additional risk associated with aiming for higher returns over the period you plan to keep your investment. The risk or volatility measured by standard deviation describes the potential highs and lows. That means the higher the standard deviation, the greater the probability of experiencing higher highs and lower lows to arrive at the average return. Overall, volatility decreases as time invested increases and/or more bonds are allocated to your investment income engine. This volatility compression based on extending time invested is clearly demonstrated in the average asset return chart that we looked at in the previous video, where the 1-year average return stock bar is much longer than the 15-year average return stock bar. Thus, as the investment period lengthens, the range of average returns narrows. So if you have a long time to invest in stocks, extending your investment time horizon is an effective way to reduce the variability of average returns. Therefore, I consider long-term investing to be about 15 years or more. Okay, so if we, I guess I'll scroll back up just so you can see that one more time, because right now we're focusing on the volatility compression, right? There's a range of, a larger range of returns, right, from these negative returns to these positive returns, even though this is the average return, and the average returns are pretty close between the 1 and the 15 year. Rolling returns, they're pretty close. But in the 1-year return, it could be every year that we're looking at, there could be 1 year where it's negative, another one where it's very high in the positive range. But as we lengthen out the time invested in stocks, we can see how that standard deviation or volatility compresses and becomes smaller. We can see that even the lows are still positive. Even though they're lower than the average return, and the highs aren't as high. Okay, that's basically what we're discussing at this moment. So let me go back over here to where we were, returns and volatility. Okay, we talked about 15 years or more being long-term investing. Decreasing volatility is also achieved by including lower volatility assets into your portfolio, like bonds. Okay. However, while achieving lower risk by adding additional bonds to your portfolio may be comforting, consider the consequences. Lowering risk usually means lower return. Lower returns suggest investing more money or taking longer to reach the same future account value. As long as you include this lower return in your plan, it's okay. But as you saw in the example about why investing is essential, when we illustrated 5% and 8% returns, there was a large difference in the amount needed to invest annually to accumulate $1 million over 30 years. Suppose that example gets adjusted just a little bit to see how lowering your investment volatility and thus your return will reduce your account value. In this scenario, assume that you want to invest $8,800 annually for 30 years at 5% and 8%. Also assume that for both scenarios, there will be a 5% return and a 5% withdrawal rate from the principal every year for 30 years during the distribution phase. Once again, this scenario will not factor in taxes or inflation. After 30 years of investing $8,800 annually at a 5% return, the account will have a value of approximately $484,000. A withdrawal rate of 5% will provide an annual income of $29,200. Over 30 years, that equals a cumulative withdrawal of $876,000. If you add that to the original account value of $584,000, there's a total value of $1,460,000. Now let's compare that to the other scenario. After 30 years of contributing an annual investment of $8,800 at a return of 8%, the account value would be approximately $1 million. A withdrawal rate of 5% will provide an annual income of $50,000. Over 30 years, that equals a cumulative withdrawal of $1.5 million. If you add that to the original value of $1 million, there is a total value of $2.5 million. The difference is $1 million. The only factor setting the two scenarios apart was 3 percentage points during the accumulation phase. So here we see that in this particular bar chart. So impact of investment returns on account value and withdrawals, total value in millions, and then we have the investment returns. In the first account, we're getting 5%, and we have an account value after the accumulation phase of $584,000. We assume it continues to produce 5% and take out 5%, so we have total withdrawals of $876,000, so total value there just under $1.5 million. Here we're getting 3 percentage points higher. The account value grows during the accumulation phase to $1 million, and then we assume 5% growth after that and 5% withdrawal, so we take out $1.5 million on top of that, so we have $2.5 million. Okay, so if you plan on 8% to make your FI work over the same time horizon, then you need to contribute to investments with that potential, right? This is the meat of the idea, right? Depending on which number you use to calculate your ending value that you're trying to accumulate. The only option, okay, so you will miss the mark if you lower the risk and get less than 8%. The only option you will have if you haven't accumulated enough capital at retirement when you start withdrawing money is to spend less. If you withdraw too much at the beginning of the distribution phase, you'll have a higher chance of running out of money. Withdrawing too much from your account is like decreasing the size of your investment income engine. Suppose you reduce the size of the investment income engine by removing large chunks of cash from it, known as principal. In that case, it won't produce as much income for your living expenses anymore. This concept is vitally important. Unless you have no choice, never invade the money you amassed for your investment income engine during the distribution phase of life. During the distribution phase, as a rule of thumb, you should only plan on spending around 4% of the total value of your investment income engine per year, even if you are invested in a stock fund, because you still need the account value to grow by the rate of inflation. And we'll talk more about that coming up. So I'll go ahead and pause here, and then we'll pick up and talk about balancing risk and return, prioritizing goals over diversification in our next video for Chapter 8, Investing.